There's been substantial student interest in today's session, Howard, as you might expect. Um, we have several pre-recorded questions, and let's start with one from Matthew Current. What's going to happen is we're going to play the question, and that'll go directly to you. It's virtual, but I know it's heartfelt. So let's hear from Matthew Current.
Hi, Mr. Marks. Thanks for taking the time to come and speak with us today. My name is Matthew Current. I'm a junior in Wharton, concentrating in finance and minoring in political science. In one of your previous talks at Penn, you had used the analogy of a baseball game and said that the current market cycle was in its 8th or ninth inning, but you had also alluded to the possibility of entering extra innings. So my question for you today is, what inning do you see our current cycle being in, and have we started a new game?
First person to ask that question in this cycle. I haven't given it that much thought. You know, it's unusually hard to answer that question today. We normally think that the market has a certain ebb and flow, and that the cycles are they're different in detail. They're different in the duration, their amplitude, their speed, but that certain things do tend to repeat from or at least to rhyme, as Mark Twain said. And you know, normally what happens is that we have an upcycle, we have increasing optimism, increasing risk tolerance, increasing good feelings because the upcycle is so rewarding, and rising prices and eventual excesses of valuation. And the same thing through the economy. We have excessive expansion and excessive hiring and leverage and so forth. Then things reverse, and we get movement on the downside, and we get falling prices and worse corporate results and deteriorating psychology and a switch from greed to fear, and we also get economic deterioration. That's the normal cycle, and it's a matter. I think the best way to think of the economic cycle and the market cycle: excesses and corrections, excesses and corrections, excesses and corrections, and a lot of the changes are endogenous. They are within the economy and within the market. This is unique because this is exogenous. It wasn't excesses of markets and economies. It was the pandemic. We had a recovery. It was basically a healthy recovery. It was a slow, gradual recovery, the longest in history, but the slowest in post-war history, and not too many excesses in the economy or even in the market. But then we had the pandemic, and the pandemic required us to close our economy in order to keep people apart and control the spread. And we had the worst quarter in history. The second quarter was down 33% on an annualized basis. So it's very hard to say what inning we're in because this is not a routine game, I guess I would say. We're at the beginning. We know we're only about 5 months into an economic recovery. We believe that recovery will last at least as long as it takes to get the economy back to its 2019 level in terms of GDP. There's some doubt now with the failure of Washington to provide support payments. There's some doubt as to whether the recovery will live up to everyone's expectations, but I think we are in a recovery. But you know, an interesting question is we never had a normal recession. We had an artificially induced recession. Are we still slated for a normal recession, or has the entire cycle been reset? And since it's only 5 months old, do we have years and years to go? I don't think anybody can say. And you know, the extent to which the Fed and the Treasury and the recovery rebuild people's liquidity and rebuild their willingness to consume, and the extent to which life returns to what it always has been is very uncertain. So I think we're in the second inning vis-a-vis the economy. Of course, the market being at an all-time high, despite the negative fundamentals, or I should say modest fundamentals, that juxtaposition gives me more pause. And I would say that the rally in the market is in the sixth inning or the seventh inning. But who's to say? If the economy is salutary for the next 5 years on an uptrend, the market will do pretty well. Although I do think that the recovery from the all-time lows in March has been very dramatic, and it feels to me, most of us, like the market is ahead of the economy.
Yeah, Howard, to follow up on that, it's been an extremely interesting and diverse recovery across styles and classes. One thing you read about in the memo is risk-adjusted return, which, of course, in some sense, leads us back to the academic notion of the Sharpe ratio. Of course, you can't eat the Sharpe ratio, right?
And
what's your view about? And you can't spend the Sharpe ratio, right? We need to hit a required rate of return. There are a small number of ways to get there. What's your view on whether we're getting paid at the right level today? And I love how in the memo you bring in the capital market line, so it fits right into my lecture notes. So thank you for that. That's a great one. But then one thing about that is the dispersion across sectors, which is really unusual. With growth and large cap stocks, for example, doing well, but there's still being a large number of industries and sectors in deep distress.
Well, Chris's reference to the capital market line, if you think about a graph with return on the vertical axis and risk on the horizontal axis, we have a point on the left side where at zero risk you have the risk-free rate. And that's usually 30-day bills, which have no credit risk and no inflation risk. And that's the lowest return you can get on anything. As you move up from that in risk, there should be an increase in the expected return. People shouldn't invest in riskier assets if they're not expected to be higher returning than safe assets. So the line goes at an angle from the left. It goes up and to the right. We call that a positive correlation, a positive relationship between risk and expected return. That's when that line does go up and to the right at a reasonable pace, we say the market's at equilibrium. And if all the asset classes are on the line, we say they're at equilibrium because they're in a reasonable relationship to each other in terms of risk-adjusted return. As the risk rises, the return rises, and that's only right. Nothing else would make sense. The problem today is that the Fed took that risk-free rate, which is here, it's the point from which all returns begin and emanate, and they pulled it down. And when you pull down the risk-free rate on the left-hand axis, the line also falls. Now, sometimes it falls not in parallel. Sometimes different parts of the line fall more than others. The slope could increase or decrease. That's the slope of the line is the risk premium. But the point is, I believe that most asset classes appear to be in equilibrium with each other. The risk-free rates appear to be proportional. The returns appear to be proportional to the risk, but the problem is that all returns are at a very low level. And as I said, the pension fund that needs 7 has a hard time getting it today in stocks and bonds, and most of them have given up on that and put substantial money into alternative investments with their illiquidity and their manager reliance and so forth. Now, the great question that I usually end up speaking about is how do you pursue a high return in a low return world? What should you do in a low return world? And I've come up with 5 possibilities, and I can't think of any more. You can continue to invest as you always have, and understand that the return you make will be lower than ever. You can worry about the level of asset prices, reduce your risk to cushion the blow if a correction comes, but then your return will be lower still. You can go all the way to cash, to the ultimate preparation for a correction, but then your return will be zero. And you better be right fast, because if you're in cash for 2 years and the market goes up, you may be looking for another job or new clients. Rather than risk reduction, you can go in the opposite direction. You can increase your risk in pursuit of a higher return, but is this the time to be increasing risk when there's great uncertainty as to the fundamentals, geopolitical, political uncertainty, in addition to economic? Or number 5, you can try to look for exceptions, what I call special niches, special people who hopefully can produce a good return with safety in a low return world. But those people are truly exceptional and not easy to find.
Yeah, truly, alpha should be, in some sense.
That's right.
Rare.
Yes.
It's hard to find. What's the